Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nick Schuurmans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management.
Welcome back to another edition of Blind Spots. We're doing the happy half hour. That's what we've called our powwows with Toby and myself. Happy half hour. It's kind of a mouthful. It might be a stupid name. I don't know. But Toby, welcome. What's going on with you?
Not a lot going on with me. I really like that name. You did a nice job coming up with it.
We've got Sunday Coffee Reads, Blind Spots, happy half hour. And for those of you that haven't tuned in to Toby and I in the past, this is more of an investment, economic themed podcast with some personal details sprinkled in. We just want to give you insight into some of our views on investment management. What you won't hear are plugs for pure portfolios or hot takes on what the market does next. So we don't make predictions. We just talk about current events and what's happening in markets. So what do you got, Toby?
I've got a number of questions for you today to pick your brain with. The first one I have for you is regarding the Magnificent Seven and more broadly sector investing. So I get a fair amount of questions. I do a fair amount of reading about, hey, you should be overweight this sector, you should be underweight that sector. This year with technology doing so well, primarily the Magnificent Seven, which is, Facebook, Google, Apple, Microsoft, Tesla, et cetera. With those kind of carrying the market this year, it's kind of come back to the forefront with people thinking, hey, maybe I should have more of my portfolio in technology stocks. So wanted to get your take on that, get your input on that. Is now a time to chase that move higher? Is it not make sense to do that at any time in your investing horizon?
There's a lot to unpack there.
I always like to start with a question that has about 6 questions embedded in it.
Yeah. And I don't know when I did this, but I wrote about the top heaviness of the market in the last couple of months. And I can tell you one, concentration among 5 to 10 stocks, let's say, propelling an index higher is not abnormal. It's actually quite normal. Sure, the leaders in the clubhouse change. Like back in the 90s, it was energy stocks. Back in the early 2000s, it was banking stocks. Now it's technology stocks. So while performance concentration is not abnormal, there is a rotation at the top. And that doesn't necessarily spell doom for the market. So I track when a handful of stocks do really well and are carrying performance for an index, that doesn't necessarily spell doom for the S&P. And that's over like 60 years of empirical data. Okay, so that's one piece. However, the Magnificent Seven, the ones that are carrying the torch, are likely going to be challenged going forward from a future return standpoint. And that's also based on empirical evidence. So the bigger you get, the harder it is to grow. It's difficult to go from a $100 billion company to a $500 billion company. It's unheard of to go from 500 billion to 3 trillion, let's say. But that's what a lot of these large companies have done. They're running into the law of large numbers. So if you're performance chasing at today's levels, I'm not saying you can't earn a reasonable return over the next 4 or 5 years, but know that you're probably going to be up against it. You might be facing some headwinds.
And just for our listeners out there, explain the concept of if something is more expensive, future returns are likely to be lower. Explain that concept, why those two things go hand in hand.
So as a stock or an index gets more expensive over the long term, that could mean future returns are lower. So there's often value in the buy, right? So like a lot of real estate people say, you make money on the buy, which is common sense, but a lot of people can overlook that, meaning your future performance, your future return for any asset class is highly contingent upon the price that you pay. And it's quite basic. Like the higher price that you're paying, future returns could be lower. The lower price that you pay, future returns could be better. So a lot of investors are constantly looking at how something is valued relative to history or relative to its peers or relative to some other asset class. And that is often a one data point. It doesn't explain everything. It's not like you can say something is cheap and you're going to make money the next year. History has been kind to those that pay a fair or discounted value for any asset, whether it's stock, real estate, what have you. So that's something that we pay attention to. One thing that I've also said is it's really complex to value some of these tech companies that make their money in cloud or AI, just because these are intangible assets that you can't necessarily touch and feel, versus back in the 80s when you were making widgets and cars and manufacturing more stuff. That's an easier business to value.
Yeah, sort of like the analogy that if there's a car and the car is worth 20,000 and you're able to buy it for 15, then the likelihood of you earning a higher return on that car because you bought it for 15 is greater than if you bought that same car for 25 or 30,000 today. Okay, that's helpful. Thinking about it, financial advice by age groups, and I know you've probably done blog posts or a prior podcast on that, but I have a number of clients that have adult children that are maybe in their 20s and early 30s, and we offer to, hey, we can help get those people off on the right foot as they start their adult life, start their adult financial life. What advice would you have for someone that's kind of in their mid 20s to call it early to mid 30s as they kind of get started? Maybe they're got their first job, maybe they've gotten married. As they get started on that financial journey, what advice would you have for someone in that age group?
My advice is simple. Optimize your savings rate. Just focus on your rate of savings. So that could mean maxing out your 401k, maxing out an IRA, maxing out a Roth, or if you're trying to buy a house over the next couple of years, just maxing out your savings account. A lot of people get hung up on, should I invest in this or that, or they're trying to market time their 401k. They're trying to make things overly complex. And the path to building wealth is actually quite simple, especially if you're young. Time, compounding, savings rate, and living within your means. It's really those four things. And you do it over and over again, year in and year out over 30 years. That's a boring, simple, tried and true way of building wealth.
In my experience, people will say, oh, I don't have enough money yet to be saving. And invariably the light bulb will go off at some point in your life, whether it's 25, 30, 35, or 55, that, you know what, I have to find a way to save some of the money that I'm bringing in so that I'll have that money to use for something in the future. Could be retirement, could be buying a home, could be buying a car, could be going on a vacation. But that's the biggest pushback I get from, folks in their 20s is, oh, I don't make enough money to be able to save money. I barely have enough money to make ends meet. And I'll admit it's not easy, but
Sure.
If you get into that habit and that discipline of setting aside, even if it's $50 a month or $100 a month, and just getting that process started, you'll be glad you did, and you learn that lesson early on, which helps you in the future.
Well, I'm glad you brought up the I don't have enough money to save thing, which is a real thing. But I also believe an underrated area of focus for younger people is focusing on maximizing your earnings, because your human capital is arguably your biggest asset. It's most 20-somethings biggest asset, meaning you have 40 or 50 years to earn money. Focus on maximizing your earnings. And it's easier now to make money in your pajamas than at any point in history, meaning there's all sorts of different ways to make money with side hustles or driving for Uber or just starting an online business. So I would, a lot of these young people are focused on, well, I shouldn't buy my daily latte. It's like, let the small stuff go. Focus on those four pillars that I outlined, but also focus on maximizing your earnings.
That's good. Okay, I've got two more questions for you. The first is this is kind of a softball, but what's one area of Pure's service and capability that you wished our clients or prospects were more aware of and tapped into more? In other words, what's something that we do today that you think we do a really good job with and you wish people availed themselves of it more frequently?
This has been top of mind for me, and I don't know what it is, but lately it seems that people are making large financial decisions without running it through our software tools and our advice first. Meaning, we've had several folks that have went off and bought a third house or a second house, and they're reporting back the numbers to see if it works in their plan. Ideally, you would run it before in your financial plan. Say, hey, I'm thinking about buying this second house. How does that affect my balance sheet? How does that affect my plan? Let's run buying the house versus not buying the house side by side and see the impact over the next 10 years rather than shoot, aim, hey, can you guys clean this up? I think I made a mess. So anytime you're making a large money decision and you're working with an advisor, that could be Peer Portfolios or another advisor, give them the information to help you make a data-backed decision, because money's emotional, right? We're pulled in so many directions to do stuff with our money and buy things and keep up with the Joneses. Run it through a objective third party, get your financial advisor's feedback, then make a decision. It might reinforce that decision, giving you some more confidence, or it might cause you to go back to the drawing board and maybe instead of buying $1 million home, you buy a $600,000 home. So help us help you make decisions.
Yeah, I think that's a big part of the service that we provide for folks. But I also think sometimes they feel like, oh, I don't want to bother them with that, or they're busy. But yeah, I think that's a great point that we want to encourage folks. If it's something that's going to impact their financial situation or something that's going to impact their future, give us a quick call. We'll have a conversation about it. You might decide to go a completely different direction than what we're advising, but at least you get that objective third party, take on what you're considering, and are better able to weigh the pros and cons. Okay, good. The last one I have is less work related, but as we head into fall, what are some of the activities and things that you're looking forward to in fall, different than, hey, I'm able to play golf in the summer or spend time with the family in the summer? What are those things for you in fall, winter timeframe that you're most looking forward to?
Fall is my favorite season, just from a weather standpoint. I like the crisp mornings. The air just smells fresher. I like the leaves and the contrast and colors. I'm coaching my 6-year-old daughter's soccer team, which we had our first game on Saturday at 8 a.m. Just for those of you that don't know, or your kids are all grown up, 6-year-old girls are not firing at 8 a.m. on a Saturday. I have never seen a more checked out group looking around, balls in play. They're talking to their brother, talking to their mom. I could have been Nick Saban on the sideline, dropping just the best advice, and they were just extremely checked out. So that was frustrating. But aside from that, school's back in swing. We got college football, which this will probably be my last year paying attention because of the realignment stuff. I'm in a fantasy football league. So just a different set of habits and routines that come with fall. What's your fall program like, Toby?
Yeah, I think I would agree. Fall is my favorite time of the year. I enjoy watching football. I enjoy hanging out with my family. Typically, we'll make a trip to Central Oregon in the fall, which is one of our favorite places and is beautiful in September, October timeframe. They're 70 degrees. The nights are cool off to 40 degrees, and it's just beautiful over there. So those are some of the things that we look forward to doing in the fall before the rain kicks in and we all get shut into our homes.
What's your feelings? Oh, sorry, go ahead. How would you characterize this year's market, and what things are you watching? What have you read anything interesting lately? What's top of mind for you as you look at financial markets?
Yeah, I think the interesting thing for me continues to be kind of the push and pull of inflation and the Fed's response to inflation and the economy. And so inflation goes up, the Fed is forced to respond. Everybody assumes that means the economy is going to go into recession. And seeing those three variables continue to interact with each other, I still think there's people that believe that economic weakness is coming. Maybe that's, not 2023 business, maybe that's 2024 business. I think there's some people that feel like inflation, although it's come down, is going to remain elevated, which again impacts the third leg of that stool, which is the Fed. And what does the Fed do? Are they done hiking rates? Do they have one or two more hikes in them Do they have to keep their foot on the gas longer because inflation remains stickier and the economy appears resilient? So that's probably the biggest thing that I'm watching and reading and listening to others talk about, is the interaction there, because it has obviously significant ramifications on the market. Obviously, we follow our rules-based approach, so we have a methodology that we can lean on as the situation changes. But I think it's going to be interesting to see whether we do get economic weakness, and if so, how significant is that? What areas of the economy are most affected, et cetera. So those are some of the things that we're watching. Certainly the market feels a lot better this year than it did last year. So, with indices up, 15% in some cases, bonds are not acting as a drag as they did last year. So definitely when we meet with clients, we're encouraged by the performance this year. But, as always, we remain cautious and monitor the situation because things can always change.
Yeah, and things change quickly. Like through the end of July, there wasn't much to complain about. Stocks, bonds, international stocks, small cap stocks were all doing well. July ended. We got into August, which is a seasonality quirk. August, September are some of the weakest months when you look back at monthly performance over the last 100 years. So there's some of that, but just fits and starts with inflation and various metrics. I mean, the Fed does have a messy job, and I've said this before. Anytime you have a uncertainty around what the Fed does next from a monetary policy standpoint, there's always an elevated sense of jitterness in the market. Like it's very sensitive to changes in language, to changes in data. So we get inflation data this week. I think we can confidently say the Fed is closer to the end of their hiking cycle than in the middle of it. So if you're, a baseball fan, we're probably in the bottom of the 8th or top of the 9th. And then the question is, does the Fed hold or do they cut? I mean, I'm really surprised how interest rates can go from 0 to 5.5% or whatever in a short period of time, and we're not off the rails. So the Fed gets a lot of flack, but they have really threaded the needle. I don't know if it's their forward guidance. I don't know if it's the resilience of the consumer or corporations, but other than the banking crisis that we had in the first quarter of 2023, it's been a pretty big surprise. And then on the performance side, it has been a little difficult because like when you strip out the Magnificent Seven, when you strip out energy stocks from last year in gold, over the last 19 months, everything else is down and down pretty significantly. So although this year has been better, this has just been a confusing, confounding, disjointed market. And again, this is kind of a plug for Pure, but I get asked all the time what the market does next, and there's people on Twitter making all these ridiculous hot takes, and they're very specific in their forecasts. It's like, let's have some humility. I mean, nothing has made sense for the last 3 years. Everybody's been wrong, and it's nice to have a framework to make decisions in this type of environment. And I use the example of us adding to equities this year. I mean, that hasn't really felt good, but it's turned out to be a decent decision because the market's always right. Price is always right. And, you can say whatever you want. You could have a fancy sounding narrative, a smart sounding narrative, but at the end of the day, markets are always right.
Yeah, and I thought it was a really good chart that we included and sent out to folks that showed performance of some of the major asset classes for 2022 and then 2023 year to date. And I thought it was interesting that no asset class other than gold is up from the last 19, 20 months, from the start of 22 until the end of August 23. Equity indices were down 5 to 10%. Bond indices were down, something similar. Real estate was down more. Longer duration fixed income was down over 20%. So gold was up, I think, 5 or 6%. So it just shows that it's been kind of an interesting investment environment over the last 20 months. And even though this year feels good, it's a reminder that, we paid the piper a little bit last year, and we're still trying to dig out of that hole.
Well, and to answer your opening question about tech, a lot of folks they overweight what just happened. And what just happened is technology stocks have had a great start to the year. But when you look at that chart that you're referring to, and for those that don't know where to find it, it's in our last week's blog post, or sorry, the week before, our August monthly commentary. It's the second slide, I believe. But if you invested in QQQ, the NASDAQ index at the start of 2022, you would still be upside down by roughly 10%. And a lot of these high-flying tech names this year lost 40, 50, 60% last year. So when you when you zoom out and look at it, and again, I'm not saying you can't own these companies, but what you're signing up for is not a license to print money. It's a license to experience negative 60%, plus 50%. So the range of outcomes for these companies is extremely wide. And what we end up seeing is when you get a year like 2023 and tech is doing well, people performance chase and they end up getting crushed. Like a lot of these names were doing well in 2021. Investors shoveled money into them. They got their faces ripped off in 2022. So just be mindful of position sizing and risk management, not get carried away. Like the AI theme, I think we could probably say is a little carried away. There's going to be winners and there's going to be losers. But if you're allocating capital to that area of the market today, probably doesn't end well. Okay, so real quick, last question, then I'll shut up. So when you watch a duck football game and they have a crane to the game like they did this past weekend, are you screaming at the TV or are you kind of just checked out?
I don't. I watch the TV. I root for my teams, but I don't scream at the TV and explain what they should be doing differently. But I don't scream or yell at the TV. I keep it fairly chill. How about you?
Well, I mean, for those of you that don't know, I went to Washington State, and I don't think we've been more disrespected. I mean, we're always the underdogs, so we're used to that. But getting left out of the Big 12 or whatever the new conference shift just kind of rubs me the wrong way, because if you look at results, we've had a pretty good football program. No one does less with more. And we really have to find diamonds in the rough and coach them up. And like nothing's easy. There's no bandwagon Coug fans, man. If you cheer for the Cougs, you are an authentic Cougar fan. So with that in mind, context, I'm a little more fired up this year, just because we're better than a lot of the teams that are getting moved to these conferences. I mean, we're ranked 22 in the country. So I'm a little frustrated. College football is a sore subject for me.
Hey, you brought it up.
I know. I shouldn't have done that. I apologize. Okay. So that's happy half hour. We're just under a half hour. That's not an accident. We're going to try to do this once a month. So thanks for watching. Thanks for listening. We encourage those to check out our other content. We've got a blog. We've got other podcasts. We do videos. It's a great way to capture insight on how we think and how we operate at Pure Portfolios. So if you have a question, send it to insight@pureportfolios.com. We'll see you next time.
Cheers.